5 years ago or something like that. And Norm Friedland is here. Norm, if you ever watched Cheers. And Eveline Gerck is here. Steve Katz is going to be moderating. So Steve, why don't you come on up? And we need more microphones, so we'll work that out. Thank you. And I think we need more microphones. There's one over here.
So, you know what? I'll give you another chair. I'm going to sit down.
You're going to sit down? Perfect. Okay, Steve's going to sit.
I can sit on this. Okay, this is good.
There you go.
This,
I know you have one.
Excuse me.
Everybody gets a mic.
Okay.
Actually, I'm going to hold on to one of them.
Okay.
so each guy's got a mic.
They have to share a mic, but we're going to have one for the audience.
It's alphabetical order.
No.
Let me just
Okay.
treat you guys.
Hello.
Hi.
So you came down from Boston, didn't you?
Yes, it is.
Hot mic, right?
Yeah.
Okay. Good afternoon. My name is Steve Katz. I'm president of Steven Katz Associates, a healthcare life science management consulting firm. I've been doing this for 42 years. Prior to that, I've had an extensive amount of corporate experience. My focus areas are licensing, capital raising, strategic advisory, proxy fights. I've been on 28 boards, public and private. And our panel today will be discussing the importance to family offices and high net worth investors and what to be looking for on A rounds, B rounds, and C rounds. And we'll be also addressing what to be looking for on early stage rounds. And we have a thoroughly experienced panel, and I'm going to introduce them. Dr. Lucas DeBreed, who works for Bright Edge, which is the venture arm of the American Cancer Society. Our next panelist is Eveline Gerck, who is an experienced executive and advisor who sits on boards and provides general advisory services. And Norm Friedland, who is an attorney with extensive experience and is currently involved for the last while in what's called mission funding, which is a funding vehicle used by private foundations that has broad application to life science healthcare as well as other areas. And we're going to speak accordingly, and I'll moderate that discussion. Our first panelist to speak will be Lucas. So Lucas, what is the overall market environment for early stage oncology investing as a result of the constriction of NIH funding these days? What kind of environment do we have on that early stage funding segment, and how has it all been impacted?
Yeah, thank you, Rob, for that question. I think it's one that I can address from multiple angles. As you heard in the introduction, I am part of the BrightEdge team, which is the impact investment and innovation arm of the American Cancer Society. But American Cancer Society is probably better known as one of the major funders of cancer research in the country, thanks to the broad support of the American public. And probably many people in the room here are regular donors to the American Cancer Society, and hopefully also volunteers in the activities to raise the money for the cause. So as the largest non-governmental funder of cancer research in the country, you can imagine that this is something that is directly top of mind, given the fact that the role that the NIH, and particularly the National Cancer Institute, has played in supporting foundational research, which we all know is at the start of the innovation lifecycle and gives rise to some of the innovations that are serving patients today. Now with that funding drying up, there is increased pressure on on this competitiveness for dollars, and therefore the value of the dollars that ACS hands out simply has gone up. And so there's a burden on the ACS to be very thoughtful of how it continues to support cancer researchers, where traditionally the American Cancer Society has taken a kind of absolute quality perspective. So not necessarily funding particular areas of cancer research, just really trying to provide general support for the space. But clearly, with reduced sort of support from the NCI, it will be important for American Cancer Society also to make some decisions in terms of how they can ensure that the entire field keeps moving forward. Now, to come back to your question, I mean, basic research is really as a foundational input into the work we're doing as early stage venture capitalists. And we try to work very closely with the scientists that actually are funded by the ACS, right? So we actually do have that crosswalk. We're not exclusively focused on companies coming out of that work, but it's certainly a line of sight that we already have, right? So we even do trend analysis to understand what we funded 5 years ago or 10 years ago, how has it resulted into new innovations that now are driven forward by biotechs.
So Lucas, now that we have those constrictions from NIH, and I know from our discussions that BrightEdge is an impact fund, and I believe the amount of funds available for investment are 80 million. I don't know how much of the fund has been spent, but will this create the potential impetus for you to be able to meaningfully accelerate the amount of capital that you have available to have a broader perspective? I understand we can talk about areas of investment in a moment, but I get it that you're focused in oncology. But do you think this is an opportunity for BrightEdge, the American
Absolutely,
to broaden its capital base in a relatively quick period of time? Because there's just a bit of pent-up demand. Obviously, the NIH funding is a constriction.
Yeah, no, that's a great point. So maybe just to hone in on that, American Cancer Society is sort of well known as a safety net organization, right? So really helping patients that are not having access to the best care options, for example, by providing lodging and transportation support. Again, all funded by donations. You can sort of take that role and actually now apply it to the early stage innovation segment as well, where we've seen investment dry up, and so there is a natural role for the American Society and specifically BrightEdge to play. But to the point about the funds that we manage, we currently manage the venture capital allocation of the ACS's own investment pool, and we've been able to grow that with dedicated donations from individuals or family offices that really see BrightEdge as a mechanism utilizing venture capital to drive meaningful change and impact cancer patients. So almost like a new tool in the arsenal of the American Society, using venture capital really as the accelerant, right? As the spin wheel, if you will, for fulfilling the mission of the society. Now, for us to continue and scale what we're doing today, yes, I think this is continuing to be a way to bring more capital in that trusts the ACS and BrightEdge specifically to allocate it very responsibly to find the areas of greatest impact potential, right? Like what is the science that really should move forward and shouldn't be dragged down now by the more macro level restrictions, not just on NIH funding, but even on early stage VC, which is also kind of widening this valley of death, which we've thought we had sort of crossed, but now we're very much staring at the same chasm that there's just simply a lot of great science that cannot move forward due to lack of grant funding and then due to lack of early stage VCs that are willing to take a big bet on something that's really disruptive. So yes, there's a role there for BrightEdge, and there's certainly a role for more dedicated donations that can actually forward and propel this very effective tool to deliver impact to patients.
Okay, so I think that you've done a good job of making clear that there'll be greater capital raising situations, and the types of investments that you would be making in that fund, from that fund, would have a nexus to the activities of the ACS. So now the question becomes, we speak of oncology, but we know there's drugs, there's diagnostics, we know there are therapies, we know that there are many, many categories of investment that come under quote oncology. There are many, many aspects to oncology. Can you comment on the areas within oncology that you would consider investing in, you have invested, and give our family offices, high net worth, and other people in the audience a sense of what activities you find desirable and of
Sure.
interest to fund?
Yeah, and this is actually great because we take a different lens than I think most VCs, in that, of course, the science and the technology and the IP are central, right? That's the opportunity for value creation. But we really start with a very deep assessment of need. What is the patient level unmet need? Sometimes it isn't to create more therapies. It actually is to create access to existing therapies, right? Or it is to be able to solve for some of the financial toxicity that comes associated with some of these price tags that we've heard about in the last couple of sessions that are really prohibitive to ensure that patients have access to that innovation. So we kind of say our motto is unmet need first, modality second, and in that sense we're modality agnostic. It can be a drug, it can be a services company that just leverages software to address financial toxicity for patients by making it a lot easier for every patient to find out what financial assistance programs might be available to them, right? Because we all know someone who's been touched by cancer, and probably we all know that it wasn't a smooth journey. Even if you go to Sloan Kettering, you still have to be an advocate for your own care. You still have to do your own research. You have to still be your second opinion. And the same would apply to how do you plan to pay for it, right? It's not straightforward if you have financial challenges to pay for the best possible care, how you would solve for that. And that's a platform called TaylorMed that we've invested in. So I think it covers a very wide spectrum, but we start with the unmet need. How can we find the most durable needs that are not getting addressed, and then find the most effective solution for it? And sometimes it can be that the most effective solution is actually philanthropic supported programs like the ACS has been doing for decades. It's not something that's
consider
back.
investing in a early stage pre-clinical drug that's an oncology drug? So that's of course early stage, pre-round, pre-A round, pre-B round, and pre-C round. Is that something you would consider, or is that kind of too early?
We have considered it, and we have done several of those. So yeah, that's very much in our sweet spot. And in today's environment, we would lean even earlier than we would have traditionally done. The key caveat is that, our checkbook isn't the largest in the industry. So we just have to make sure that whatever step we fund will be enabling for other investors to come in. We need that leverage, if you will, on our investment, but we're happy to lean into something that we think can be majorly disruptive if some critical de-risking takes place. As a matter of fact, we did that in a company called Modify Bio, focused on brain cancer. They were still preclinical, needed to run some couple of key experiments to really understand what was the molecule that they were going to take forward. It was very hard for them to get support. A number of families, family offices, and mission-aligned investors like BrightEdge showed up. We did the critical de-risking, and then actually Merck came in and bought the company.
So that poses another interesting question. We understand that there'll be an exiting party, and we all look for that, obviously. But will you, and you may have alluded to it earlier, and I may have missed it, but if you're going to make an investment of X, and we'll talk about funding levels in a moment, are you open to co-investors so that if you're coming in with X dollars and Merck, somebody else, up in La Roche, some other major pharma or biopharma company, will you consider a co-investment? Do you want to manage it? Do you want to be the lead investor? How does that work?
Yeah, so for the early stage opportunities, I think there's this natural lead role for us, right? Where our interest has a signaling effect on others. Whether that's on pharma, I would argue it's equally, if not maybe more valuable for individuals or angel investors that like to
Co-invest.
follow, the work that we do and why we've selected this, particularly also if they have an impact objective, right? That's, I think, what we stand for in all regards. And as part of our investment, we do require access to the boardroom because we do want to ensure that we have that patient centricity top of mind when the strategy is set or strategic decisions are made by the company. So even though we're regularly one of the smaller investors, certainly over time, we continue to have that influence because we are the patient's voice in that boardroom. And that's something that can typically well align with individuals or family offices that would like to show up and do something in the cancer space.
Be an indication of the level of investment you make? What have been the ranges of investment from X to Y dollars? What would that typically be?
Yeah, I think at the lower end would be 250,000. We're talking about initial investment, 250,000 up to say, maybe maximum 2.5 million. And then over the lifetime, we're unrestricted, but we are guiding towards about 10% of total funds. So that would be 8+ million over the lifespan of the company. We can't invest in public. We can't invest in IPO. So it's throughout the private rounds.
So
We tend to come in and then follow.
by what you're saying, forgive me, I'm not trying to
No.
interrupt as much as I'm trying to get some clarity.
Sure.
So you'd be willing to consider a $500,000 round subject to benchmarks. You put in another 500 or $1 million, and you would consider later stage rounds up to a 10% fund balance limitation is what you're saying.
That's correct. Yeah.
Terrific.
Yeah. And we try to lock in the ownership percentage that we can sustain. So again, we want to be a long-term partner, even though we can't write the biggest checks, but we also want to secure that access. And that means you got to pony up in the consequent rounds as well.
Terrific. How should high net worth investors and family offices look at BrightEdge, a venture fund, not independent of ACS, a co-investment partner? How should they be looking at you? How would you characterize that you should be viewed?
Yeah. So maybe just to come back to what I said earlier. So we've had this existing mechanism where we have had dedicated donations. We have now had 8 individuals or families contribute $500,000 or more to support the overall BrightEdge activity set. Some of that has gone into supporting actually mentoring new entrepreneurs. Some of them actually, again, ACS funded researchers that are now going biotech entrepreneurs, or just having those dollars come into the larger pot to actually support the investing activities. Now, several of these individuals have indicated that they would also like to have co-investment rights, right? Because they like the idea of a gift that keeps on giving, because it's an evergreen fund. So you put in $500,000. If you just project forward, that $500,000 should grow with every successful investment, and therefore your gift keeps growing. But beyond that, of course, there's also an interest in returns, financial returns, and the belief that you can follow us with our double bottom line objective of not just focusing on areas for the patient level social return, but also financial returns, which we have to, not just to grow our own activities, but also to be compatible with other investors in our syndicate, right? We can't be the money that doesn't care to make returns if we're trying to partner effectively with pure financial investors, right? So we truly adhere to a double bottom line perspective. And so far, so good. I mean, we've had 8 exits out of 22 investments made since 2019, and we're in the top part of that vintage year. So I think we've got early evidence that you can actually have your cake needed too.
You've done some good work.
No, diagnostics, medical device, services, health tech. Again, we're modality agnostic as long as it really aligns with this being the most effective solution for that durable patient need that somehow is not getting addressed or not sustainably addressed, right? If the ACS has to keep on putting donor dollars to work to actually address that need, and there's an innovation that can do that with a business model associated with it, that obviously is something that we're very excited to back, because that actually should relieve donor dollars for other activities.
All right. Thank you very, very much. I think that was a clear and comprehensive talk. Eveline, I would like you to speak a little bit about A rounds and larger rounds. And my first question would be how should family offices and high net worth investors be looking at and evaluating later stage A round, B round, and further transactions and investment opportunities? How should they be looking and viewing those transactions?
Yeah. So first of all, it's really hard for a family office to be invited to a hot A round where you have all the venture capital funds there. So unless you know somebody, for instance, one of the funds that I am on the advisory board, the KFund, we have been able to get into very interesting companies because we knew somebody who was like a CEO or a CFO, or, you need to get an entrance like that. And number 2, also you have the right of first refusal. You got to, have those funds allowing you to come in. So to make a long story short, the only way to really participate effectively is either coming to a secondary or an SPV. So you're never going to be invited as a family office unless you're like this huge billion-dollar family office. In fact, you will be like one of the first calls to be part of that. But if you are a small family office that you're writing $250, $500, $100,000 check, you're never going to get into a round company unless you are invested in a fund, and then the fund allows you to co-invest in that company. So that's one of the best ways to participate. Otherwise, and again, the secondary. Problems with secondary is that usually when the secondary hits the market, it's already like, everybody has it, right? So it's one of the reasons funds like secondaries and large investors is that you can come in and you pay 50% discount or more sometimes, right? But if the company is really hot, you don't even have that discount. So to make a long story short, I think that really the only way to effectively participate is to either go through an SPV of a fund that you are invested that, allows you to, or if you haven't, somebody you know that is doing a secondary offering.
Okay. How should family offices and high net worth investors view A round and greater next rounds done overseas? Should there be a difference in how they look at U.S. transactions and overseas transactions? Are there issues to consider here? How would you define that?
Yeah, so overseas is the planet, right? So let's talk about, I am on the board of directors of Friends Viad Sarah, which is a nonprofit in Israel. So I'm also on the investment committee there. So we see a lot of stuff happening in Israel. And recently, I just joined the board of a cancer therapeutics company. And this is an interesting story, but to make a long story short, I always end up joining boards because a family office is an investor and asked me to come in. Just as a caveat, in my previous life, I was a fund manager in private equity and also in venture capital. And we have 6 and then 10 large family offices. We manage the capital for them. That's how I built that network. And very often they come to me when they have a project to participate and help, this company to grow or, to a next level. And sometimes involves also capitalization. So one example, I think that in the case of Israel, the companies are they are so sophisticated, the technology is so advanced that if you really look into this opportunity, it's like a privilege if you can invest in companies that have the technology in Israel. And by the way, having said that, I'm in the Friends of Yad Sarah, but I'm the only non-Jewish person there. So if I had to say that, I'm not being biased here in terms of being Israeli or Jewish. It's just that they're really, truly super smart. So recently, I'm just back from Istanbul. I was in Istanbul, in Stockholm, and in London. And this venture that the grants and most of the research are from London and in Stockholm, and the manufacturing is in Istanbul. And so I've never been to Istanbul. So I was like, I even had a haircut because that's what I'm going to find there. So when I got there, I was really amazed at the level of technology that they have in biotech. I didn't know they had a biotech hub there. So how much you don't know, right? So look at that experience. So I was doing due diligence, like if I were an investor until I made a decision, okay, I can be part of that board. And to make a long story short, in health or in any other sector, when you look at companies overseas, you really should have knowledge of looking at companies overseas because you need to see what is their strategy. Like the particular company, they have, UK and Sweden, which is like not a emerging markets, but the way they want to do is to have a manufacturing facility in the US. So that's an expansion. How do you do that coming from emerging markets country? I'm sorry. So what I'm trying to say is that looking overseas, it's not like you need to have experience because overseas is, like I said, is the planet. It could be a biotech company in Turkey, it could be a biotech company in Sweden, it could be, another like technology company related to devices and then you have currency exchange, you have political risk, you have labor issues, you have so many things like, but to make a long story short, at the end of the day, we talk about round A. The major problem, if you are a family office looking to a company like that, is always the cap table. The cap table. So my advice is that if you look at companies overseas, look at the cap table, look at the financials, and don't get in love with a particular therapy or something like that. Because at the end of the day, it's not only the science, is a company. And people sometimes forget
agree
that.
with you more. People tend to focus on the technology and don't focus on who owns it, who controls it, and what the shareholdings are. That's a very significant point, which brings me to my next question. And you alluded to this earlier. Do you think that these kinds of investors that are in our audience, should they be making investments directly, hiring somebody to help them with diligence like yourself or others? Or do you think that they should be going through fund managers? Because you spoke of the competitiveness of the VCs and the other institutional and professional investors. So do you think that a high net worth and family offices, unless they've got a lot of sophistication internally, should they be working through intermediaries to access these investments? Or do you think they can do an effective job of getting to transaction sources independently? What? Oh, should I do that question again?
I understood.
Should I run that again, Marty? Should I ask the question again? Yeah. So you alluded to this earlier, where you talked about family offices and high net worth investors having the ability to get the transactions. So the natural question to ask is, should family offices, high net worth individuals be seeking them on their own, working with somebody to do diligence, or should they be going through fund managers, intermediaries, investment bankers, where all that work is being done, in advance? How do you think that can go down, or can high net worth investors and family offices get a good shot on their own, hiring their own diligence people, et cetera?
Okay, so depends on the size of the family office, right? So if you're like a small family office and, you're a doctor, you probably had the expertise to look at therapeutics and, in healthcare companies. You probably don't have the expertise to look at AI companies. If you are a large family office, you have people in your team that if they understand, the healthcare space, they should be investing in that. If not, just don't go there. So to make a long story short, in every area, not only in healthcare, you should only invest in what you understand. Most family offices are invested in real estate. It's safe, provides like cash flow. So when they go into something separate, primarily health, is either because somebody in the family was sick, or they have they had Alzheimer's, or they have cancer, and then they are passionate about that. But to invest in that just because you like the segment, you should then, I think, unless you know the company and you know somebody who knows the company, if it's really very specific, it's very technical, it's not only in healthcare, in any other area, if you don't have somebody to help you, you're making a bet. So in that sense, it would be much better to put money in the American Cancer Society Fund, that they know what they're doing, and then you participate, and then you get involved, and
So
that's what I think.
This nets out to expertise and capability to evaluate and assess, is basically what you're saying.
Yeah, because
So that,
again, if you have very different, you don't have like one entity that is a family office. You have a family office that is $1 million, one that's 5 million, one that's like $1 billion, like most partners. So you have family offices that are really like companies, are like really investment firms. And they have the smaller family offices, which are like, somebody had an exit, or somebody inherits money and things like that. And you want to participate in those different investments. I think that the best way, unless you know the area, if you're passionate about it, don't know, you should either participate through an SPV or investing in funds like the American Cancer Society or the KFund, funds that have some health investment.
I don't disagree with you at all. But my experience has shown that beyond the point that you're making, and it's valid, many of these family offices and high net worth investors have a number of situations that gives them capability. They focus on AI, they focus on biotech, they focus on small cell, cancers, and they have some degree of expertise. They kind of know what they're looking at. The bigger ones have capability and expertise, or they have access to expertise. So I think it's a mixed bag. So if the particular investor has experience and capability in an area, and having one or two investments is a lot of experience and capability these days in venture capital, because you see all sorts of issues and problems. I think that's a good basis to make future investments. And that brings me to my next question is, what do you see happening, and why do you see that A round, B round, C round investments fail and crash? What's the biggest basis for those casualties in your experience? People go in, they pre-A round money has gone in, friends and family has gone in. Now there's an A round or a B round, and the deal crashes. Why do you think that happens often?
What do you mean the deal crashes? Which deal? What are we talking about? Which deal is the company? Which deal crashes? The fundraising, you mean?
So an investor invests in pre-A round.
Okay.
X dollars gets raised. Now an A round investor comes in. Now a B round investor comes in, and the deal fails or the deal crashes. Why does that typically
When you mean
happen?
the deal is like the company fails?
The entity that receives the
Okay,
investments.
the company.
Why do those fail?
Why companies fail? Oh my God, that's a long. Let's have a dissertation about that.
You and I know why they fail, but I'd like the audience to know why they fail.
No, they can fail for very different reasons. Sometimes you are in a market and you are like a hot company. Everybody's invest, and you have a new technology and turns on you.
15 for no. Okay.
And usually in A rounds, again, is always something related to the cap table and go to market. So, at the end of the day, a company is about management. I don't care which area they operate, and most of the times, we have also companies like, for instance, the KFunds. We invested in a very late stage in a company called Core Weaver. I mean, you can't go wrong with that company. What are you doing like data centers? That's like the hottest IPO. We had the IPO, we left at the IPO, but after the IPO, the company started crashing. I mean, what do you know? It's Core Weaver, it's in all the newspapers. So, you have so many factors that can impact. What I can tell you right now is that when you talk about why companies fail, why companies succeed, and again, I think that a lot of family offices and investors do that. You need to acquire sometimes expertise in something new. You're like in your 40s and 50s, and you need to learn something new. Like, I have to go deep to learn AI. Thank God, previous in my life, I was a coder, I was a system analyst, so I can understand what's going on. And I could migrate, and I went to different, webinars and classes, and I look at a bunch of companies. I did due diligence. And now I kind of understand when it's bullshit AI and it's not bullshit AI, because everybody's putting AI behind, after the name. And so now I can do a due diligence on AI, but I had to really train myself on that. So I think that is happening nowadays. You have to train yourself in different areas of expertise to look at companies. And
Eveline,
my advice is learn AI.
Marty's giving me the signal. I've got 15
All
minutes
right.
left. So you said something valuable, and I'm going to close with that and ask Norm to speak. You said it comes down to management, and I think that's what it does come down to. So that when investments get made, whether it's early stage, A round, B round, or C round, I think the biggest thing to look at is what's the quality and experience of management. Thank you for your comments. I'd like to ask Norm Friedland to say a few words. And once again, Norm is an experienced attorney, and he's going to talk about mission funding. And Norm, my first question is, what is the overall market environment for early stage companies as a result? Sorry,
Wrong question.
I read you the wrong question. My apologies to the audience.
You want me to answer it? I know the
No,
question.
don't answer that. That's not within your script.
Karnak, it's a,
Your company is FullSky, and what is the FullSky model for mission funding different from conventional return on investment transactions? So you bring private foundations in. How do they look at transactions differently than normal return on investment deals that a fund would make, et cetera?
okay, thank Steve, thank you. Marty, thank you. I don't know where you are. Pete, thank you for hosting us. Let me do a quick commercial for BrightEdge. We work with a lot of family offices in the cancer space, a lot of patient advocacy groups. BrightEdge is really the only vehicle that we know on a global basis that has a focus on cancer via the American Cancer Society. So if you're looking for real investment impact or patient benefit and the ROI, BrightEdge is your place to go. So that's an unsolicited commercial. I want to change the dialogue slightly because the topic, the words that have been used are investment, investors, investment. And when you look at the life science space, you're looking at a world of 15 to 20,000 diseases, of which the for-profit pharma companies are giving you solutions for about 700. So what that tells you is that, 90% of the diseases, which are called rare diseases, there is no pharma or therapeutic solution. Now, a rare disease is fine unless you have it. And if you have it, it's not rare. And so what we're focused on is sourcing the capital, not as investment, but as what we call ROM, return on mission capital, to provide these solutions that are accessible and affordable and realistic. And so what we're looking at for family offices is a pool of capital that are your philanthropic assets. It's the assets in your private foundation. It's the assets in your donor advised funds. And what we're able to do is we're able to show that family office that has those philanthropic assets, how those assets can be used to fund not simply a grant for a researcher to write a paper or to have a conference or to put their name on a building, but to find a company that has a solution that is a realistic solution for the disease category they're interested in. It could be cancer, it could be pediatric, it could be neuro. The categories really don't matter to us, but the whole focus is that mission capital drives the patient benefit. And it drives the patient benefit from the philanthropic assets, which are not designed to generate ROI. And there's some specific ways that you can do that under IRS approval that we understand.
So it's a very noble investment thesis. They're looking,
Steve, funding thesis.
it's a very noble funding thesis with a greater emphasis on doing good, so on and so forth, with a lesser emphasis on the financial return.
Correct. And I'll give you an example. They're sitting here in the audience today. A company came to me a couple of months ago that has a fundamental cancer diagnostic solution. It's, and I don't want to get into the weeds of it because I'm a C- high school biology student, but you're talking about the ability to identify one cancer cell in about a test tube of blood, which has 10 or 15 million other cells in it. The ability to detect that one cancer cell will revolutionize how precision medicine, how precision cancer is going to occur, because now you're able to find that cancer cell before an MRI, before an imaging, before a biopsy, You're able to monitor that patient through the clinical trial phase. You're able to monitor that patient through the remission phase. And not only are you going to change the trajectory of cancer mortality, which hasn't changed, by the way, in the last 40 years, except for smoking and some life science, but you're saving the healthcare system billions and billions of dollars by avoiding unnecessary tests that don't tell you what it is that you want to know. And so if you're interested, Sina Nasserian is over there. He can take your blood and tell you what it is you have. But this is an example of a company that needs to have the mission capital versus the ROI capital, because this solution has to be made available to everybody and not simply the people who can afford to pay it or people who have insurance.
Okay. Is there a transaction size limitation associated with mission funding?
Absolutely not. We're working on deals that range from $3 to $5 million to about $150 million. The
biggest mission fund that's been done so far, not by you, but just in the industry.
Great question. It's probably Gates. I'm trying to think of which one they've probably done that failed, by the way. It was for a company called Lindra, which had a drug delivery platform. They put about $50 million into it. And to go to your point, it was management. $300 million and
lack of management.
Yeah, lack of several rounds of management.
And the board.
Yeah, and the science didn't fail. The science was spectacular. But we're very optimistic. I mean, the things that we're seeing in terms of cancer, in terms of other solutions, the things we're seeing sounded like science fiction 5 years ago. And the things you're going to be seeing 5 years from now sound like science fiction today. And the only way these solutions are going to be made available, in my mind, is through a combination of mission capital, which comes in as a part of a capital structure with ROI capital, where the mission capital is first loss, but it can jumpstart a company and support the company through the valley of death.
So the last question I have, because I'm going to get the signal and the hook to get off stage, is does mission funding apply to drugs, devices, therapeutics? Are there any limitations on the genre, nature of the opportunities?
No, we're seeing mission capital opportunities across the board. In the drug therapy space, in the drug repurposing space, in the drug device, in the device space, and especially and critically in the diagnostic space. Because
so I've seen a lot of drug repurposing transactions across my table in the last year, and it's good that you please continue. It's good that you comment on that.
Well, again, the real focus from my perspective, and again, I say this as a C- high school biology student, is without the fundamental information from a diagnostic, everything else you're just shooting in the dark. And you know, the statistics show it. You've had no improvement in cancer mortality to speak of. The cost of those cancer treatments are over the moon or around Jupiter or whatever you want to call it.
They're getting to 300 to 500. Did you want to comment on that?
Yeah, and I think this point is really critical, because there is a fundamental misalignment with how the industry works, from industry, where there is a lot of focus on linear innovation with a certain threshold of commercial value, which innovation is not linear, right? There's heaps and bounds, and that's why being able to unlock the value through better precision, even if that means you're going to end up with a smaller pie, but you're going to be able to shift the outcomes for patients, that is extremely worthwhile. And as a matter of fact, because you can get in at a low price, these are effectively discarded assets, right? Pharma has shelved them, so you can get them relatively cheaply, but with sufficient precision, you can go after them even for a small TAM and still do well, both on the social impact as well as on the financial side of things, because precision means relatively cost-efficient R&D. So the numbers actually still can work, but sometimes this is something that only comes to the imagination of financial investors in the final stages, and the mission capital needs to bring these stories to fruition.
Well, exactly. And if you combine the precision diagnostic with the mission capital, with the right management, with the right ROI capital, you've got a solution that's going to work. And so, you know, we've had the opportunity of talking to BrightEdge over the years. We really do respect them. Family offices that you work with, we'd love to talk to them, because what we think we can present them with opportunities for their philanthropic assets that have much greater impact than simply writing a check to a worthy organization that really doesn't deliver any patient benefit.
Norm, do you have any summary comments? Because we're coming to the end of the sand in the hourglass here.
Marty, thank you very much.
That's it?
That's it.
Okay. Thank you, everyone.
Great job. We're going to move into real estate right now. We've got Doug O'Donnell, who does a bunch of industrial real estate, and